Hello and welcome to a CMS Forex daily video recap. I'm your fundamental market analyst. Today is Friday, June 11, 2010. Let's start in the UK, where manufacturing data came in unexpectedly weak, surprising forecasts on the downside for the month of April. Industrial production was down 0.4% on the month, lower than the forecast of a 0.4% gain. That followed a rather strong 2% increase in March. It was the first fall in monthly terms since January, and the annual rate was up 2.1%, weaker than the pace we had seen in March, which was 2.6%. Manufacturing production was also down 0.4% on the month. Britain faces a public spending squeeze at home and the threat of contagion from the debt crisis in the euro area, its biggest trading partner. Officials were counting on factory exports to aid expansion after the pound dropped about a quarter on a trade-weighted basis since the start of 2007. However, so far, that has not been the case. Therefore, today's data was rather disappointing, and it's a sign that the economic recovery may be struggling to keep up its momentum. A second report showed that producer prices rose 0.3% in May in monthly terms, less than the medium forecast for a 0.5% increase. That followed a 1.6% rise in April. On the year, factory output prices were up 5.7%, a slower rate than what we had seen in April. Input prices, meanwhile, month on month, fell by 0.6%, mainly reflecting a fall in the price of crude oil. Taking a look at the pound-dollar chart, we see this rally throughout Wednesday and Thursday as we moved up from our low for the week around 400 pips, climbing from 1.4350 up to 1.4750. However, following our production data around 5 a.m. Eastern, we saw the pair give up more than half of its rally for the week, falling back down to test the 1.45 area. Drawing a Fibonacci retracement of our rally for this week, we see that we moved below the 50% level, which was around the 1.4550 area, and we came to support at the 61.8%, rather standard correction to a rally. Now, today's production data also when it came out, corresponded to a test of a resistance level at the 1.4750 level. As we can see, this was our high on June 2nd, and if we go back further than that, it was also a level of support, which now turned to resistance back here in June. Today's low, being a 61.8% retracement of this up move, will be an important support coming back from the weekend. And if we move further below, then we do have a chance to test our low here or from this week. But if we bounce up, then again, the important level to watch would be this 1.4750. Now let's take a look at the US fundamental releases for today. First off, consumers paused their spending spree in May as retail sales for the month of May were down 1.2%, a much weaker figure than the 0.2% forecast. Sales had been pretty healthy over the past few months as they had increased 0.6% in April and jumped 2.1% in March. Breaking down the figures somewhat, we see that sales excluding autos decreased 1.1% as there was a 1.7% decline in auto sales. This was an interesting reading as new motor vehicle sales were up 3.8% for the month, so the weakness could have been in used cars, parts, or in prices. Meanwhile, gasoline sales were down 3.3%, so if we take a look at sales excluding autos and gasoline, we had a 0.8% drop. Digging even deeper, we see that weakness was primarily focused in building materials subcategory, which plunged 9.3%. However, this component had jumped 8.1% in March and 8.4% in April, so in context it may not be such a terrible fall. Now, if we exclude autos, building materials, and gasoline, sales edged up 0.1% in May after decreasing 0.2% in April. So we'll see what happens with that building materials category in June's figure. Still, the weak retail sales did set a negative tone for the opening of U.S. equities, and we did have, for the most part of the New York morning, equities trading in the red until they turned around and actually gained late in the New York session in pretty much the last hour or so. Now, while sales were down in May, the UMich consumer sentiment, the preliminary version for June, came in actually rather positive, as confidence among U.S. consumers rose with the index climbing to 75.5 from May's 73.3. That reading beat forecasts, and we saw increases in both the current conditions and future expectation. The gauge of current conditions, which reflects Americans' perceptions of their financial situation and whether it is a good time to buy big-ticket items such as cars, rose to 82.9, the highest since March 2008 from 81 in May. Meanwhile, the index of consumer expectations for 6 months from now, which more closely projects the direction of consumer spending, increased to 70.7, the highest since September, from its 68.8 reading in May. Sorry, I had a typo there. Also of note, consumer inflation expectations declined rather sharply during the month, with the 12-month outlook falling to 2.7%, which was a 0.5% decrease from the previous month. Overall, today's report, because of its strength, hints at some underlying improvement in the jobs market and should offset the sting from the May retail sales report. Finally, business inventories in the U.S. rose 0.4% in April to extend this year's run of gains. The build in inventories continues to lag sales, no surprise given the lag time for production and still conservative business outlooks. Business sales rose 0.6% in April on top of March's 2.5% surge. The inventory to sales ratio held at a record low of 1.23, conclusive proof that businesses are reluctant to pay the costs for inventories. Taking a look at the euro-dollar pair, we here too see a rally throughout most of the week, and then we paused in overnight trading at the 1.2150 level. That was our support that was broken in last week's trading, so very important level, and so we came up against it and were unable to move above that level, and then as we had the U.S. retail sales release come in weaker than expected, we saw the euro give up some of its overnight gains, and then we actually fell even further. So by noon we had tested the 1.2050 level. However, in a late rally in U.S. equities, we did see the euro-dollar pair come back up somewhat. As you can see, the fall here was not as sharp as in the pound-dollar pair, and if we actually look at the Fibonacci retracement of this move, a full move this week, upward rally, we see that we tested the 38.2% retracement here. So far, shallow correction to our rally, and when we come back from the weekend, we have our important resistance level set up at 1.2150. And on the downside, we could look to test this 100 period moving average, which would correspond somewhere near the 50% retracement level of our full upswing. Turning to one of our currency pairs that was very strong in this week's trading, the Aussie-US dollar pair, we see this rally of about 400 pips during the middle of the week. Here too, as similar to the euro, we did pause at resistance at 0.85, though here at the end of trading, we were actually testing that resistance to end the week. So as we can see, quite a shallow correction to this upward rally. Zooming this pair out, we see that we are close to a very important resistance level, as we did have this sideways range throughout late May and June, and coming into this week, we tested the bottom part of that trading range around 0.81, and we made a full rally up to the top part of this trading range. So a break here would be a very bullish indication for the pair and give it a chance to retrace further this very sharp downswing we had seen throughout most of May. However, if we come back from the weekend with risk aversion being a major theme, then we look to retest this 0.81 level as support. So let's take a look at the fundamental docket for next week. From the US, we're going to get a good amount of data on the manufacturing sector, including Tuesday's Empire Manufacturing Index report, Wednesday's industrial production figures, and the Philly Fed Index on Thursday. Also next week, we get data on TIC capital flows. We also get data on inflation, including producer and consumer prices, as well as housing starts and building permits figures on Wednesday. Around the world, we start off with New Zealand retail sales, followed by the Reserve Bank of Australia meeting minutes. On Tuesday, we get UK consumer prices, which will be followed on Wednesday by the UK employment report, the claimant count change and unemployment rate. On Thursday, the UK posts a third important release in retail sales. On Tuesday, Germany releases its EW economic sentiment, a good leading indicator for the German economy. And on Thursday, the Swiss National Bank has its interest rate decision. It'll be important and interesting to see what they feel about the Swiss franc and its appreciation against the euro, as well as its intervention in the currency markets recently. So that will do it for our coverage of the Forex markets for this week. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you a great weekend.